Thanks for clicking. There are other ways to fight inflation rather than just raising interest rate. This coming from a new report from Desjardins.
It'll just work itself out naturally.
Indeed, the report from Desjardins comes amid a new widely publicized article from David Rosenberg, arguing that the Bank of Canada has done enough to tame inflation, and as of right now, is doing more to push up prices than it is to reduce them. Rosenberg's article echoes another one from TD Bank's Craig Alexander, which we talked about in another video, which argued that if we take mortgage interest costs away from the CPI, our inflation is sitting at 2%, well within the target range, and as such, the Bank of Canada has done its job. Others, such as Benjamin Tal from CIBC, argue that this line of thinking doesn't quite understand the way inflation works. Regardless of who is right, regardless of the best manner of getting inflation under control, evidence is growing that Canadians are starting to buckle under the weight of higher interest rates, with NDP leader Jagmeet Singh just this week proposing that the government look at subsidies for those struggling with their mortgages.
No f***ing way.
And as such, it's worth considering whether or not there's other options available to slow the pace of Canada's price growth. So what I want to do today is briefly go over what causes inflation, take a look at those arguments saying the Bank of Canada has done enough to reduce it, and then take a look at some options that are available to reduce Canada's inflation rate without raising interest rates even further. The end of the month is fast approaching, and the local real estate board should be releasing July's data in early August, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into inflation. First off, I want to just briefly go over what causes inflation. The U.S. Federal Reserve, arguably the most influential and most important central bank in the world, says that inflation is caused when the money supply outpaces the growth of production, outpaces the ability of the economy to produce goods and services.
Inflation is caused when the money supply in an economy grows at a faster rate than an economy's ability to produce goods and services.
The IMF, the International Monetary Fund, echoes this statement, noting that if the money supply grows too big relative to the size of the economy, the unit value of the currency diminishes. So, if the central banks create too much money, if too much money enters the economy from nowhere without corresponding production, then the value of that currency, which was printed, diminishes.
This is flippin' awesome.
And we're seeing this at play in Canada right now. As we've talked about before on this channel, Canada's money supply exploded in the wake of 2020. And it's not just in Canada. In the United States, their aggregate money supply increased by almost $6 trillion over the period of 2 or so years. So, if inflation is caused by the money supply expanding faster than the economy's ability to produce goods and services, and the US and Canadian economies were producing money, were expanding their money supplies at the fastest rate in 50 years, at least, while simultaneously shutting down production of goods and services, then we're going to see inflation. And while the pace of the growth of that money supply is slowing, even reversing in some cases, all that money that was created during those few years is still out there. And we've seen article after article in Canada alluding to this, noting that the pandemic savings of Canadians, all of that money built up while we were expanding the money supply, is enabling some Canadians to be able to continue to spend. So the question then becomes, if all that money is still out there spending, all of that money is out there creating inflation, pushing up prices, how do you pull that money out? The primary manner in which the central banks, the Bank of Canada, has been doing this is through interest rates. While some, such as David Rosenberg and Craig Alexander, are arguing that if we take mortgage interest costs out of the CPI, that we're well within the target range at 2% and thus the Bank of Canada's job is over, others, such as CIBC's Benjamin Tal, do admit that mortgage interest costs are deflationary in nature.
Nobody will be able to convince me that higher mortgage interest payments are inflationary. They are disinflationary. When you and I have to pay more on number of mortgages, we pay less on something else. We spend less. Therefore, it's disinflationary.
So, when Canadians have to pay more towards interest, more towards their mortgage payment, they have less money to spend out of the economy. They're spending money that is going to the banks. Less money out of the economy, more money to the banks.
It's the least we could do.
I should briefly note that Tal does subscribe to the mortgage interest cost argument that the Bank of Canada has done enough, but we've talked about potential reasons for CIBC wanting the Bank of Canada to reverse in other videos. Regardless, the goal of the Bank of Canada's interest rate hikes is to pull money out of the economy vis-a-vis people having to pay more in interest. The bank sprayed the economy full of money throughout COVID, and now the bank has to pull that money out if it wants to reduce inflation. However, there is only so much that the Canadian economy that Canadians can take, and interest rate hikes are a very blunt tool which has various divergent effects on the population. And signs are growing that Canadian homeowners are buckling under the weight of higher borrowing costs. Holders of variable rate mortgages with adjustable payments have seen their interest costs rise over 70% in the past year. Those with fixed payments have seen their amortizations increase by 60, 70, 80, even 90 years in some cases. And Canada's banking regulator is intervening to ensure the banks think twice before they extend amortizations ad infinitum. And given all these pent-up problems starting to emerge with the higher cost of borrowing, Desjardins says that there are other ways that Canada can slow down its price growth without resulting to more interest rate hikes. First, the central banks could always speed up the process of reducing their balance sheets, and by this they mean quantitative tightening, mainly selling Canadian bonds. During COVID, the Bank of Canada bought up nearly $400 billion worth of Canadian government bonds, which was one of the main ways in which the government financed the pandemic.
Right away.
Okay.
The Bank of Canada still has the majority of these bonds, $303 billion worth, sitting on their balance sheets, meaning they still own these bonds. Were the Bank of Canada or the central banks to sell off their government bonds, in theory, this would remove $303 billion of liquidity, of cash, out of the market. That's $303 billion not available to lend out, not available for refinancing, not available for spending. Desjardins notes that although this would indeed suck a lot of liquidity out of the market, it would also result in unwanted consequences that would be difficult to control. It would also probably increase mortgage rates dramatically, as bond prices would tank, but that's a discussion for another time. As such, Desjardins says that that's probably not the best policy tool, and one more desirable tool that the government could do would be to raise taxes while, and this is the important part, constraining the growth of spending.
That's not possible.
So, pull money out of the economy, put it into government coffers, and don't spend it. Tax increases, says Desjardins, would allow the government to more equitably distribute the burden of reducing inflation. So, the argument is that when the central bank, the Bank of Canada, raises interest rates, it hits homeowners disproportionately. But if the government raised certain taxes, it could target certain areas of the population, pulling out money from where it chooses. So what Desjardins is saying is that we do have at least some measures available to us, other than further interest rate hikes, to get the money out of the economy. Regardless of what you think of the policy prescriptions being put forward by Desjardins, they are at least acknowledging the heart of the inflationary problem, that is, the money supply. When we look at the arguments being put forward by TD, by CIBC in some cases, by Craig Alexander, by David Rosenberg, all of these arguments are couched in one way or another as to how we're measuring inflation, how we're measuring how much prices have risen from this point in time last year. When, as we talked about in another video, we can see that the apparent sub 3% inflation data is due in large part to base effects, and that if we compare prices just to 6 months ago, inflation has accelerated to almost 2.7%. So obviously, inflation is still very much with us, and these arguments are failing to consider, even acknowledge, the money supply. The money supply which is at the very definition, at the very cause of inflation itself. And I think going forward, any discussion as to what the Bank of Canada should be doing, what the Bank of Canada has done, and their effects going forward, not to mention what the government should be doing, needs to include a discussion of the money supply. Failing to consider the effects of the money supply and what that would do to prices is how we got into this situation in the first place. With all of that said, on this channel we will continue to track Canada's money supply and the Bank of Canada's and the Government of Canada's efforts to limit it. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.